I think gold is in a secular long-term bull market. I think that is an area that you want to buy on dips. Gold will be making new highs in the next several years. Gold is trading more as a currency and less as a commodity. So gold is trading like a currency that is no country's liability. It's a great balance in the portfolio, and it's extremely correlated with uncertainty. So that is something you want to have. And as you can see, Bitcoin has been crunched because everybody thought that Bitcoin was digital gold. And I kept on saying, no, 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 no. Bitcoin is correlated with the NASDAQ 100. Take your pick. That's concentrated risk. Bitcoin does not have gold's characteristics.
Gold has certainly done very well for investors of late. The price has reached a record high in real, inflation-adjusted terms, passing the record set in 1980. Yet this has been a surprisingly stealthy bull market. It would be an exaggeration to say that it's gone unremarked, but there has been far less discussion about gold than during the big mid to late 2000s bull run. Founder of Rosenberg Research, DavidRosenberg, predicts a secular gold bull market, recommending buying on dips. He emphasizes gold's strong correlation with uncertainty and contrasts it with Bitcoin, which he argues is more correlated with the NASDAQ 100 and lacks the stability of gold. Bitcoin's price has declined 24% since hitting a record high of more than $109,000 on January 20th, the day crypto-friendly President Donald Trump took office. Conversely, gold has kept rallying, gaining nearly 8% in the same span. The contrast highlights the different factors driving the prices of the two assets. More importantly, it also suggests that investors looking for a store of value, or even an alternative investment uncorrelated to the stock market, would probably do better with gold than Bitcoin. From a technical perspective, DavidRosenberg explains that rising uncertainty widens risk premia across asset classes, including credit spreads in bonds and lower stock market valuations. Concurrently, Rosenberg also expects the Federal Reserve to cut interest rates more aggressively than currently priced into the market, suggesting that U.S. Treasuries could be a good investment. The Federal Reserve is likely to resume cutting interest rates in June and could reduce short-term borrowing costs again in September. Traders bet on Tuesday as they took on board the implications of a widely watched survey that showed consumer confidence dove this month and inflation expectations surged. Drawing a parallel to 2019, Rosenberg recalls how policy uncertainty led to a capital spending recession, which prompted the Federal Reserve to cut interest rates even before the COVID-19 pandemic. Now we present the clips of DavidRosenberg's insights from their recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
What does rising uncertainty mean? Rising uncertainty means widening risk premia across all asset classes. It means credit spreads, investment grade high yield, they will be widening. It means that whatever your estimate of the fair value price earnings multiple is in the stock market, that will be declining. And of course, it could affect, layered on top of that, all the fiscal uncertainty, how much duration you're going to want to have in your bond portfolio. I think that what all this means is that the confidence bands around any forecast, macro or market, the error term much higher than it normally is, much higher by several standard deviations. The confidence interval is much wider, the range of outcomes. So uncertainty means exactly what Jay Powell said it meant several meetings ago when he explained why are we going on hold in this environment of uncertainty is because when you're in a dark room with furniture, what do? You just stand still. You don't move. And that's going to apply to the economy too. That means that liquidity and savings rates will go up in the household sector, the expense of spending. Companies will be shelving capital spending plans because of all the uncertainty. That's what uncertainty does. It has an incrementally negative impact on aggregate demand without you doing anything outside of just creating this incredible period of policy uncertainty. By the way, we saw this in 2019. This is on a much grander scale. In 2019, we had a capital spending recession. We didn't have an overall recession because the tax cuts were giving some nice impetus, lingering impetus to the consumer sector. We had a capital spending recession in the second half of 2019, rather unexpected. That's why the Fed cut rates 3 times before COVID. So it means that you've got to cull your portfolio to really best ideas. I think you've got to de-risk your portfolio. If you're in the equity market, I would be in areas that are not correlated with the economy. So the most defensive sectors with visibility, that could be consumer staples, it could be utilities, healthcare. I think that one thing that Donald Trump has made great again is European defense stocks. I mean, the European stock market has had a great year. Of course, there's tremendous valuation support there. But the one thing Donald Trump has done, and appropriately so, and especially with this Ukraine situation, is he is forcing Europe to finally live up to its NATO commitments. And all of a sudden, you've got this debt break in Europe. You've got room being made for more defense spending, and not just there, but in Asia as well. Japan's increasing its military budget. So defense aerospace is one area in an uncertain world that has a lot of certainty around or visibility around their future earning streams. I'd be taking profits in those Mag 7 stocks, which probably should have done a couple of months ago, and deploy those into European defense stocks. So that's what I'd be thinking about in terms of equities. I'd be taking down my allocation and I would be very defensive, reducing the beta. But there are areas to put money to work in, and defense stocks abroad are in a bull market. I think gold is in a secular long-term bull market. I think that is an area that you want to buy on dips. Gold will be making new highs in the next several years. Gold is trading more as a currency and less as a commodity. So gold is trading like a currency that is no country's liability. It's a great balance in the portfolio and extremely correlated with uncertainty. So that is something you want to have. And as you can see, Bitcoin has been crunched because everybody thought that Bitcoin was digital gold. And I kept on saying, no, 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 no. Bitcoin is correlated with the NASDAQ 100. Take your pick. That's concentrated risk. Bitcoin does not have gold's characteristics, and we're living that through right now. So gold, and I would say the Fed will be cutting rates. I think more aggressive than what's priced in. So I would say that the Treasury market, you can pick your spot along the curve. I think Treasuries will be a very good place to be in the next 12 months.
Significant debt issues have arisen in the past, but the decades-long, increasingly unchecked erosion of democratic decision-making presents an entirely different situation. Seasoned investor David Rosenberg discusses rising uncertainty in global markets, primarily driven by escalating trade tensions and fiscal policy challenges. He highlights the unpredictability of the U.S. and China trade war, its impact on automotive sectors, and the potential for a government shutdown due to congressional gridlock. In the recent financial report of the United States government for fiscal year 2024, the Department of the Treasury projects that debt as a percentage of gross domestic product will grow to more than 5 times the size of the U.S. economy in the next 75 years. The report provides a comprehensive view of the federal government's finances and illuminates the nation's unsustainable long-term fiscal outlook. The United States debt-to-GDP ratio is projected to rise from 98% in 2024 to 535% in 2099. Additionally, Rosenberg points out fiscal risks related to the expiration of the 2017 tax cuts and the complexities introduced by technological shifts, including concerns over potential overinvestment in emerging technologies like deep-sea innovations in China. Let's get back to the interview.
The fact that we're on the precipice of a global trade war. So the uncertainty really stems from, we were told, what do we do? Do we take Donald Trump literally, seriously, or both? If you remember back in Trump 1.0, we were told to take the president seriously, but not literally. And now we're finding out that we have to take them both seriously and literally. And so, the tariffs on China, the tit for tat there, that's just rewriting chapters of a book of this economic war that's been going on between the U.S. and China for many years now. But the trade war being unleashed in North America, Canada and Mexico, especially what it means for the auto sector, is huge. So I think it's related, the uncertainty is related primarily, but not exclusively, to the trade side and how this is all going to play out. And then the other layer of uncertainty is on fiscal policy. Circle March 15th on your calendar. Are we going to have a government shutdown? We have really a dysfunctional Congress, almost split evenly between the Republicans and Democrats in the House. The Republicans have the grand total of a 3-seat majority. And I'm not so sure that the Senate version and the House version of the budget bills are going to mesh together. Will they mesh together in time to avoid a government shutdown, which would just be an added complication to the economic and financial market outlook? There's a chance that this time around we won't see a rescue at the last second. But even on top of that, we don't know by the end of the year whether or not the president is going to manage to prevent the economy from falling off the proverbial fiscal cliff, because many of the provisions in the 2017 tax relief bill sunset at the end of this year. And if they're not extended, that will be a massive fiscal drag on the economy. So that's why Donald Trump needs all these tariff revenues. Now, he's couching it in terms of national security, but he needs to find money. That's why Doge is doing what it's doing. He needs to find money to prevent deficit projections, as bloated as they are, from going up even further, because he wants not just the tax cuts to be extended, which are massively costly. I mean, you're talking, what, $4.5 trillion of additional deficit projections for the next 10 years just from not allowing the 2017 tax cuts to sunset. He's got to find money for that, let alone all the other goodies that he was campaigning on last year. No tax on tips, no tax on Social Security, free root beer and the water fountains at every school in America. I mean, you name it. So the fiscal outlook is also very cloudy. And that's a distant second, I'd say, to what's happening on the trade side. And then, of course, we had one shock a couple of years ago with NVIDIA and the massive shift in the technology innovation curve that propelled the stock market to back-to-back years of 25% price return gains. And then we got DeepSeek coming out of the shadows in China, and all of a sudden creating some uncertainty as to how much of this capital spending has already been wasted in terms of investing around this theme. Not that the theme isn't valid, but the question is what sort of overinvestment's already taken place. So that's added in another layer of complexity when you look at the stock market, especially since it's as dominated now by technology as it was back in the late 1990s.
Although gold prices have fallen below $2,900 an ounce as investors booked profits, one market analyst said the precious metal remains well supported. Rising inflationary pressures and the risk of a global trade war increase the likelihood of policy mistakes by governments and central banks, which could further boost gold prices. Given the escalating economic uncertainty outlined by David Rosenberg, how do you plan to adjust your investment strategy to safeguard your portfolio and capitalize on potential opportunities? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.